Hello and welcome to the Roundup, covering what's important to accountants and advisors across August. This month we're looking at a case that explores the timing of income received by a taxpayer who changed residency. We'll also look at the tax treatment of taxi industry compensation payments. But first up, the ATO have released a final determination in the luxury car tax space. It seems to be looking at whether the vehicle is mainly used to carry passengers. Now, Matthew, what's the relevance of this, and why would we be interested in what type of purpose the vehicle has?
Sure. Before I jump into the determination, the starting point with luxury car tax is that it normally applies when you've got a client that's gone and bought a luxury car where it exceeds that luxury car tax threshold. Just be a bit mindful that that threshold is slightly higher when you're dealing with a fuel-efficient vehicle, which is quite nice. And there's a number of other exceptions as well. For example, if the client's gone out and bought a second-hand car that's older than 2 years, then there's a potential exemption there. One of the key exemptions, though, is when the client is buying a commercial vehicle that's not designed with the principal purpose of carrying passengers. And this is where the determination comes in. With some commercial vehicles, you can potentially argue that they're mainly designed to carry goods instead. And the ATO does tell us through its determination how the purchaser intends to use the car is not really that relevant, but rather you'd need to focus on the car's inherent design. And this is not necessarily an easy area, because the ATO does give us a number of factors that we can look at to come to a determination, but no one factor is necessarily conclusive on its own. For example, you need to look at how the vehicle is presented. You need to look at how the vehicle is marketed. Is it being marketed predominantly to tradespeople? Is it being presented predominantly as a goods-carrying vehicle? As well, you'd need to look at the vehicle's inherent specifications, its passenger carrying capacity, its load carrying capacity. Having said that, the ATO does make things a bit easier because they've come out with an administrative approach on different vehicle types and what they see as high risk and what they see as low risk. And it's that risk rating that drives the level of ATO compliance resources that they'll dedicate to reviewing a particular arrangement, or really in this case, a particular car. So if you've got a client that, for example, is looking to buy a passenger wagon, an SUV or a station wagon, and they're looking to try and argue that that vehicle is not designed mainly to carry passengers, well, look, the ATO says that that's probably quite high risk from their perspective, and they're more inclined to want to double check that. On the other hand, if your client's gone and bought a truck or a delivery van, the ATO says, well, that's probably going to be quite low risk, and that's unlikely to attract ATO attention. When it comes to utes, which are becoming quite popular these days, including dual cab utes, the ATO does say that that's likely to be seen as quite low risk, but only if the passenger carrying capacity of the ute is less than 50% of the total load carrying capacity of the vehicle. And there's a formula for that. And basically we take the number of passenger seats, including the driver seats, in the ute, and we multiply that by a set number. That number is 68 kilograms. We then take that figure and compare that with the remaining load carrying capacity of the vehicle to determine whether it's designed mainly to carry passengers or luxury car tax exempt because it's not designed mainly to carry passengers. Now, this formula isn't entirely groundbreaking because it's basically the same formula we use to determine whether a dual cab ute qualifies for the FBT commercial vehicle exemption. Now, it's just that with that FBT exemption, you still also need to look at how that dual cab ute, that vehicle, is being used by the employee.
Are there any flow-on impacts from this determination into, say, the depreciation space or the GST rules when it comes to dealing with cars?
Look, that is an excellent question. While the determination strictly deals with luxury car tax, at least I think there should be some flow-on implications for other areas as well. As you've mentioned, we've got the GST car limit. We've got the depreciation car limit as well. And when they apply, they basically cap the GST credits and depreciation deductions when a client buys a car up to a different but specific limit. Now, it's firstly important to just be aware that these limits could only apply to a car. And a car for these purposes is a motor vehicle that's designed to carry less than 1 tonne and fewer than 9 passengers. Luxury car tax could also only apply to a car, but it just works a bit differently because the luxury car tax rules use a higher load carrying capacity threshold of less than 2 tonnes. So conceivably, you could have a client that's bought a car that's subject to the luxury car tax, but because the vehicle is designed to carry a load of 1 tonne or more, it's not a car for the purposes of the GST and depreciation car limit, so that those 2 limits don't apply. But once you do have a car, the depreciation car limit still should not apply if the vehicle is designed, the vehicle is not designed mainly to carry passengers, right? The language and the wording between those 2 provisions are so similar that presumably, and I can't see a reason why I wouldn't be applying the same approach between these 2 provisions. In fact, I've seen a couple of private rulings where the ATO, when dealing with a dual cab ute, has used that same formula approach to determine whether the vehicle is designed mainly to carry passengers or not for the purposes of the depreciation car limit. It's just that you can't rely on a private ruling that's been issued to another taxpayer. And I feel like there was an opportunity to try and put something out there that was formal, public, and binding, but it's just the ATO hasn't done that, unfortunately. Now, with GST, the argument is so much stronger because the GST Act, the exclusion for vehicles not designed mainly to carry passengers in the GST Act, links directly into the luxury car tax provisions. Now, we get a lot of questions on the GST car limit, and we also get a lot of questions on the depreciation car limit as well. And I guess what I'm trying to say here is that if you've got a client that's gone out and bought a car that's designed to carry less than 1 tonne, fewer than 9 passengers, but that car is over the cost limit, and they're using that car for work or business purposes, look, it's still worthwhile to just go that extra step and just do a bit of a check to see whether the vehicle is designed mainly to carry passengers or not, especially if you're dealing with a ute. There's some potential legitimate tax savings there, and I suspect your clients don't necessarily want to miss out.
Now to that tax case where we're looking at when the taxpayer received income when they changed residency. Michael, what happened with this case?
Yeah, this is a case that in some respects might feel a little bit unfair when we hear about what happened in terms of what the facts were and what the tax outcome was, because it very much looked at that concept of when is income derived and how does that interact with the tax residency status of a taxpayer. So this was the Tawfik case. It was an AAT decision. And basically what happened was the taxpayer was a non-resident for a period of time working overseas. And as a very general rule of thumb, if you're a non-resident and you're earning employment income from work you're performing overseas, that normally won't be taxed in Australia. It's normally foreign sourced income, and non-residents are normally not taxed in Australia on foreign sourced income. Now, in this case, the taxpayer basically finished up employment overseas and was due to return back to Australia. And they did that and they became a resident of Australia. Now, this taxpayer became entitled to effectively a performance bonus in relation to the work that they'd performed overseas. Now, the problem was that the employer wasn't in a position to be able to pay that bonus in full immediately. And so what happened instead was that this bonus was paid over a period of time in instalments. But those instalment payments were received after the taxpayer had become an Australian resident again. And this was the problem. And so the AAT were basically looking at when was that income derived, because if it was derived while the taxpayer was overseas and classified as a non-resident, then it shouldn't be taxed in Australia. However, if that income was derived after the taxpayer became an Australian resident again, then basically they're taxed on worldwide income, and that bonus would be taxed here even though it related to work performed overseas. The AAT looked at Carden's case, and this is one of those famous old cases that we look at from time to time. And basically that case confirmed that when it comes to employment income, normally the income is derived on receipt, or when the income is applied on your behalf. The problem here was the income was received after the taxpayer became a resident of Australia. So even though it related to work performed overseas and while they were a non-resident, it was derived while they were an Australian resident and therefore taxed here. This is in some ways quite similar to another case we saw a few years ago, the Blank case. Dealt with something reasonably similar, and this one went all the way to the High Court. And the High Court in that case, again, confirmed that the taxpayer was assessable because the derivation of the income occurred after they became an Australian resident again. It just shows the importance of timing. Where we have clients who are maybe returning to Australia from overseas, the timing of when certain forms of income is received can be absolutely critical in determining whether that income is taxed in Australia or not. I mean, it's something that we can possibly help our clients with from a proactive planning point of view.
So is there anything we can do to help clients that are caught in a similar situation like this?
Yeah, there's three things that come to mind. The first one is just simply being a bit proactive around situations like this. Now, in this particular case, it seems like the employee, I mean, there wasn't a whole lot they could do about it. I mean, this situation was kind of forced on them by external factors. The employer simply didn't have the money available to make the payment. Now, in some cases, there might be an ability to influence timing of receipt of payment or when returning to Australia, residency status starting again. So there might be situations where some proactive planning can make a bit of difference. Aside from that, there are two other things that we would normally look at. The first one is looking at whether a foreign income tax offset could potentially be available. Now, that might not have been relevant in this case because that system is only really going to kind of give you any sort of tax benefit here if you have actually paid some income tax on the income overseas. But where clients are subject to some sort of foreign income tax on income that ends up being taxed here in Australia, there will sometimes be an opportunity to claim that tax offset and at least pay less tax in Australia than you would otherwise. Those rules are complex though, and the thing just to be a little bit careful of is the tax offset that's claimed in Australia will sometimes be less than the amount of actual foreign tax paid. The other key thing with that tax offset is it's basically use it or lose it. It's not refundable, it can't be carried forward, it can't be converted into any sort of other tax relief. So if you can't use that tax offset in full in the current year, then whatever's left over is basically lost. The third thing that is just worth being aware of is within the tax system, there is another tax offset that we refer to as the lump sum in arrears tax offset. And it will sometimes be helpful for clients who are receiving a payment this year that maybe relates to amounts that have been accrued or earned in previous years. Now again, it won't help every single scenario, but it's something just to keep in the back of your mind because sometimes that offset will help clients pay less tax now than what they would otherwise do because of the receipt of a lump sum payment that maybe would have been taxed at lower rates had it been spread out across maybe a few years. Now again, that offset is only aimed at certain types of lump sum in arrears payments, but it's something just to double check whenever clients are receiving something now, which looks like it relates to income that might have been earned or carried over from previous years. It can sometimes help lessen the tax burden. Similar relief can also apply in connection with, say, the Medicare levy system. So it's always worth just having that in the back of your mind when clients do receive those lump sum payments.
Now, there's been a lot of upheaval in the taxi industry over the last few years, and as part of that, some licenses have received compensation payments. Now, a new case looks at the tax treatment of those compensation payments. Michael, what have the AAT said in this regard?
Yeah, so this is an area that we've seen some developments on over the last few years, including some ATO guidance in terms of how compensation payments made to taxi licence holders in particular should be treated from a tax point of view. This particular case, this is the Baines case, it was an AAT decision which looked at a payment that was made to someone under Victorian scheme. And this was a payment that was basically designed to provide compensation for financial disadvantage that was suffered by this particular taxpayer. Now, the issue here was whether that payment should be treated as ordinary income and taxed on revenue account. And that ATO were basically arguing that this payment should be taxed on revenue account because it appeared that at least some element of that payment was designed to compensate the taxpayer for lost income. Although the payment was also designed to compensate them for the loss in value of the license that they held as well. Now, we've seen some guidance from the ATO in the past suggesting that when someone receives a compensation payment, we certainly need to look at what that compensation payment relates to, what's it meant to represent, what is it compensating for. And there is some guidance from the ATO saying that where we have a lump sum payment, and part of it relates to something that's of a revenue nature, and part of it that relates to a capital nature, we need to determine whether we can reasonably apportion the payment to those different components. If there is a revenue component and a capital component, and there's no way of apportioning the payment between those different components, then the ATO suggests that we should default to capital treatment. Now, in this case, the ATO was arguing that this was a revenue type payment because it was relating to lost income, and we would normally deal with those things on revenue account. But the AAT disagreed in this case. The AAT said, yes, there were two elements to this payment, but on balance, this was effectively a discretionary payment designed to provide financial relief to someone who had suffered a form of financial hardship because of changes that had occurred in the taxi industry. So even though, yes, there might well be a linkage to lost income, as a whole, this payment should not be treated as ordinary income. Now, unfortunately, the case didn't go to the next step of then saying, well, what do we do with the payment? Presumably, it would be dealt with on capital account, but there is just that lack of extra analysis and detail in terms of could it then qualify for any concessions. There are some concessions in the CGT system for certain types of compensation payment. There are other concessions, things like the CGT discount, etc., that may well have been relevant in a case like this, but the case doesn't go quite that far. The key thing here, though, is that across Australia, different state and territory governments have been making payments to taxi licence holders, but we wouldn't necessarily expect that they would always be taxed in the same way. For example, sometimes those payments are made basically as compensation for someone giving up the licence that they hold. If so, we would expect that to be dealt with on capital account as the disposal of the asset, and that will be dealt with a little bit differently. So we need to be careful to not take too much out of this decision. Just because you might have a client who holds a taxi licence and they might receive a payment from the government in relation to that licence and some sort of financial loss that they might have suffered, just be a little bit careful. We need to look at what does that payment actually relate to determine first, could it be taxed on revenue account as, say, ordinary income? Is it designed to compensate them for deductible expenses that might have occurred? If so, that could be taxed on revenue account as well. Otherwise, we'll need to do some careful analysis around the CGT position and look at whether any concessions or exemptions might well be available.
And that's the roundup for this month. There's always a lot going on in the profession. Knowledge Shop can help you and your team stay on top of change in a very practical way. Give the team a call on 1300 378 950 or check us out at knowledgeshop.com.au. We'll look forward to speaking to you soon.